Most people spend more time picking a Netflix show than deciding how much life insurance they need. And somehow that feels exactly right for how we treat this stuff. But here's the thing, what you lock in at 30 could be the single most financially consequential decision you make before you ever earn your first gray hair. Let's set the scene. The average 30-year-old is juggling student loans, maybe a mortgage, possibly a toddler who eats exclusively goldfish crackers. And somewhere buried under all of that is this nagging feeling that they should get around to life insurance. Meanwhile, the actuarial tables are sitting there, quietly, patiently, knowing something you don't, that you are, right now, at peak insurability, and the clock is already ticking. Here's the core mechanic you need to understand. Life insurance pricing is essentially a bet between you and the insurer about when you're going to die. And at 30, you are statistically a terrible bet for them. That's a beautiful thing, because terrible bets for them mean embarrassingly low premiums for you. We're talking potentially $20 to $30 a month for a $500,000 term policy if you're healthy. The contrast between 30 and 70 is almost satirical when you lay it out side by side. At 30, you're underwriting gold. At 70, insurers look at you the way a used car dealer eyes a 1992 Civic with 200,000 miles possible. Sure, but not cheap. Now let's talk about the two roads, because this is where people's eyes glaze over and they go back to the Netflix problem. Road 1 is term life clean, cheap, brutally simple. You pay, you're covered for 20 or 30 years, and if nothing goes wrong, the insurer wins the bet and keeps your money. Road 2 is permanent life, whole life, universal life, where the policy is designed to follow you to 70, 80, 90, and beyond. But the premiums reflect that ambition with the enthusiasm of a Michelin-starred restaurant bill. Here's the irony. Most financial content won't say out loud. The people who win with term insurance are technically the ones who die during the term, which is a sentence that belongs in a philosophy class, not a sales pitch. But the disciplined 30-year-old who buys a 30-year term invests the difference in premiums and actually follows through statistically. They come out ahead of the whole life buyer almost every time. The historical pattern here is almost embarrassingly predictable, and yet every generation rediscovers it fresh, like it's a plot twist. The insurance industry has sold permanent policies as wealth-building vehicles since the early 1900s, and the debate about buy term and invest the difference has been raging since at least 1979, when the first index funds started making the math really awkward for whole life advocates. Let's kill the biggest misconception right now. Permanent life insurance is not inherently a scam, and term insurance is not inherently a waste. Whole life makes genuine sense for high net worth individuals using it for estate planning, business succession, or specific tax strategies. It is a tool. And the problem is, when it gets sold as a Swiss Army knife to someone who just needed a spoon, the actionable lesson from every financial cycle and every version of this debate is remarkably consistent. Buy the coverage you actually need first, then optimize. A $500,000 30-year term policy bought at 30 locks in your family's protection for the exact years your financial obligations are heaviest, the mortgage years, the college tuition years, the what happens if I'm not here years. What you do after locking in that foundation is where the nuance lives. If you have maxed your retirement accounts, paid down high interest debt, and still have capacity, then layering in a small permanent policy for estate or legacy purposes is a rational, not irrational, move. But process before conviction, foundation before decoration, boring before brilliant. The psychological trap that costs people the most isn't choosing wrong, it's choosing nothing, paralyzed by the complexity of a decision that has a pretty clear answer for most people. At 30, healthy, with dependents or debt, a term policy is almost always the right first step. Not because it's perfect, but because it's done. And done beats perfect in insurance, the same way it does in exercise. Here's your philosophical anchor for all of this. The goal isn't to win the insurance game, the game where you secretly hope the payout is never needed. The goal is to build a life where the coverage becomes quietly irrelevant while still being silently essential. Discipline in sizing what you buy, consistency in keeping it, and patience in letting the decades do the work. That's the whole strategy. At 70, you'll either look back grateful for term coverage that cost you almost nothing and protected everything, or you'll have a permanent policy that became a sophisticated estate tool. But either way, the person who wins is the one who started at 30, instead of waiting until 45 when the premiums are different and the options are fewer. The irony of life insurance is that the best time to think about death is when you feel the most alive and the least likely to need it. Whether you're thinking about protecting your family, building long-term financial security, or you're just finally ready to check this off the list, check out our links in the description below. We can help you get started, whether that's in real estate investing, home contracting work, or connecting you with the right lenders and coverage professionals to build your foundation the right way.